event. Basically, today I'm going to share about what has happened in the past 6 months in Malaysia's markets and what we are looking into the second half and beyond. I think everyone is affected by the COVID-19. However, the market, the equity market was quite robust, which you can witness not only in Malaysia, I think in most of the markets as well. I think in Malaysia's markets, the market on 19th of March, actually we had hit a new low of 1220. That's in fact is the 12-year low since the last financial crisis. Since then, the markets have recovered about 25% from 10 actually. That's basically driven by 4 factors. One is because of the liquidity, the domestic liquidity, where the governments have cut, the central banks of Malaysia have cut rates, where the SSR had cut by actually one time the 100% basis point to 2%. That has actually added about 28 billion ringgit into the money system, the M1. And the OPR actually cut 4 times in total 100 basis points or so to 2%. That basically is the low also since 2008. Beside that, the governments have dished out 4 packages. There's unprecedented scale, 295 billion ringgit. That's helped to support everyone across these markets as well. And beside that, I think that is the expectations of the strong earnings recovery from the second half of this year and onwards. But I think the question remains that that will be tested when our second quarter's result, which is going to be released by next month, and that probably gives us a better colors or better pictures how these corporates fare in terms of their earnings and going forward. And beside that, there is also an expectations of the containment of the COVID-19 by the end of the year. But I think looking at it, it's not so easy. For the stimulus package itself, out of the 295 billions, you can see is that basically in February, the first package is 20 billion ringgit, and 230 millions in March itself, April another 10 millions, and last month got 35 millions. In total, 295, you compare to 12 years ago, the last financial crisis, the governments actually have introduced about 67 billions. And you compare to 20 years ago, that was only 7 billion. So the amount is huge. But the direct funding for the governments actually is only 45 billions. That actually about 3.1% of Malaysian GDP. You can see that what the government's direct funding, basically we have the wages subsidies. They hand out to the N40 and the B40, and the assistance to the small and medium enterprises and the rest. And even with household, we got our telco discount. We have the electricity bill discounts, the subsidies itself. The GDP itself, this stimulus package, actually it widens the government's debt to the GDP to 60%. Because you can see this is the second stimulus package. It will increase to 58%. By 1%, third one is 58.8, and the latest one is about slightly more than 60. From last year, is about 52.5%, and we have expect that the GDP to contract by 2.9%, close to 3% this year. That's versus last year, the real GDP growth of 4.3%. And just how the first means driving factor for the market, which is liquidity. You can see is that the M1, when the central bank cut the rate, the SRR by 1% is going up, and we expect actually is to go up further. And for the OPR, the 4 times that which it cuts in total of 1%, that's actually have resulted 12 billion ringgit interest saving by the borrower, and all this actually had poured into the stock market system. So what so far from these packages that directly go into household income, total actually is 72 billion. First, there's a 4% deductions in our pensions fund contributions to the EPF. That total about 10 billion ringgit. And there is and the member can withdraw about 500 ringgit per month from the account too. That's actually amounting to about 40 billions. And the handout from the Prihatin National, which is to the B40 and the N40, there's about 10 billion ringgit. And the OBR card that just I mentioned is about 12 billion. So total is 72 million. And beside that, the borrowers actually they can relieve to serve their loan for 6 months from April to September. Of course, we don't have the amounts here, but definitely the amounts will be quite sizable. So with that, actually, with the household incomes have increased, we can see that the retail participation has shot up actually. Beginning of the year, it was about 15%. The retail participation make up the 15% of the market volume, but now it's actually increased to 40%. And beside that, actually, we also because of the lockdown in 18 of March until I think just 2 weeks ago, and then we slowly lift up. So that 3 months, we see a lot of retail participation because I think no one got anything to do. So at home they will just do this. Casino is closed, interest rate is low, so they might as well use the money to roll in a stock market itself. Our sister company, Rakuten Malaysia, in April itself, they saw a record high of new signing account, actually 11,000. There's about 100% jump from 1 month ago. I mean the month before, the month increase. So that shows that this is just one broker itself. Can you imagine that we got more than 10 brokers? The new account signing for online is tremendous. And that's probably just tells that why the market is so robust. the retail investors, they are the one that actually have been supporting the market. Surprisingly, they've been the net buyer since the beginning of the year. Where you can see, and even the market crash, they continue to buy, and until today, they make quite good returns. I could say that actually they beat a professional fund manager this round. I think this is quite amazing actually. These tables which shows that the participations between the foreigner, the local institutionals, as well as the retailer. The blue bar actually is the foreign investor. The green bar is the local institutional. Then the red bar is the retail, the retailer. You can see there's the foreigner actually is a net seller. Actually, for the past at least 5 years, you always see that net for the whole year. The foreigner is keep selling and get out from Malaysia, and that also tells that why the Malaysian market underperform the regional market. I mean, in ASEAN itself, against Singapore, against Thailand, Indonesia, and Philippines. That's one of the reasons. But looking at the charts itself, we have seen the record high of retail trading volume. The value is about 13 billion weekly in mid-May. That's actually is the highest that we have not seen for the past 10 years. So this foreigner, they have been skip selling. Even the CI have recovered after the plunge on the 19th of March they still continue to sell actually. And you can see is that their shareholdings in our index, the CI index, now is closest to 16%. This is also a multiple year low. And beside that, if you're looking at this orange line, is actually the top 50 stocks and also closest to 15%. So it's actually quite low. So going forward, now the questions that we want to ask, whether the authority will still continue to cut rates to sustain the liquidity, so that the market will continue to rise in the second half. View is that yes, we think that the central bank will cut another one more round for the OPR by 25 basis points for this year. In fact, the meeting will be next Tuesday, which is where we expect the central bank is going to cut the OPR to 1.75 by then. And second question is to ask is that whether the foreigner will come back or not. We believe it's a bit unlikely because the COVID-19 is still ongoing and we don't see any improvements for now. And also I think in Malaysia, the politics is a bit uncertain now, so why they want to take a risk, and probably they will just come back more and everything has settled. And thirdly, whether government is going to continue to pump priming or to dish out packages to help the public. The question is that because just now you can see is that the debts, the government's debts actually is make up 60% of the GDP. So the government balance sheet is quite stressed. So I think the question is how much they can still dish out. Then come to COVID-19. The second wave is quite alarming, where you can see that these two graphs basically just show you the US and India. The new cases you can see is in America actually now is hitting 50,000 new cases daily, and India also more than 20,000 a day. So I think it's not it's a bit worried on that. But luckily in Malaysia, I think for the past 1 week we have recorded low single digit new cases. Hopefully, touch wood, there's nothing we will see another spike in new cases going forward. But worldwide, the number is still increasing every day. And thirdly, the rise in the stock market also partly because of the recovery, the price recovery of oil and gas, of the crude oil prices as well as CPO prices. But now the question is that whether this current prices is supported by the demand side. Of course, most of the time, the demand to see a normalized level, it will take time. We think it's likely will only happen in next year. And in fact, I think worldwide growth for second half, it will remain negative, meaning to say is that you may not see a strong recovery on these commodity prices going forward. Now, what are the risks that we are seeing from here? Definitely is corporate earnings. We are going to see the worst second quarter's earnings, which is going to be released by next month, because in Malaysia, we have locked down almost entire second quarter, 3 months. I think it's closest to 3 months. It's 2 months and 19 days. So it's just left with about less than 2 weeks in second quarter. Meaning to say is that the second quarter will be very bad. And then we have to see how is the recovery in the earnings in the coming third and the fourth quarter. And the other questions that you're probably going to ask is that with all this, is the banking system in Malaysia okay? How this credit costs will get when all the borrowers start to pay their loan in after September. And all those restructuring and reschedule loans will be turned into bad debt. So that's another question. And thirdly, I think this is very important. Is about the reform, the fiscal reform and the institutional reform have taken a setback after we changed the government again in March in March this year, and I think you can see that there's some poor governance issues there. And thirdly, of course, is the political situations here is a bit uncertain. Anytime could be a snap elections that will give some uncertainty to the markets itself. Then next year, we still our base case is that definitely 2021 will be a recovery year. But I think the road to recovery will quite rocky. We think that there's no need to make any provisions under the moratorium and the INR. But I think the excessive view of these options may be questioned. Then the upticks in the credit cost from first quarter onwards is expected, given the MLRS 9, which the banks are required to have a forward-looking requirement for their assessment. And of course, we think that our bank systems are okay. There's not a concern because the bank capital adequacy is currently still quite strong at about 14.8% at their Tier 1 cap ratio, and the LLC also at 126%. Then the bank, the central bank interest rate cut, we think that if they were to cut below 2% for SSR to increase the money supply, then that probably was going to compress the net interest margin. So that's probably not a good for the bank. And for the 25% SRR, sorry, the 25% 25 basis point cut in the OPR, which we expected this year. We did this with things that is just to fight for the current problem. Then the rest will probably leave it to the earning recovery in 2021. So far, our forecast actually, we expect our earnings are 3% lower than the consensus. We expect the 13 FTSE KLCI stock, their earnings to achieve 87.8% next year. That's compared to the consensus, which is slightly lower than 21 cents. So I think the downside risk probably lesser. What are the governments can respond to other than whatever stimulus package that they have announced? I think that's all depends on what the government is going to privatize those infrastructure projects. I think this is the easier way to come up with the country economy. So far, the MRT2, I think there's a big drag, but it's still ongoing actually. The MRT3 is still under negotiation. The PEM Borneo in Sabah Sarawak, the highway, is still ongoing. And then subsequently, I think they have to see what the federal government is going to do to revise those projects that have been delayed. Things projects such as like the MRT3, and then the Penang Penang Transport Master Plan. I think the state government of Penang had just started launching beginning of this week. But I think with the scale of 32 billion ringgit, they really need some assistance from the federal government. And beside that, there's a 3.2 billion projects within Singapore JB, the RTS system. And lastly, is of course, I think the way to increase the government's coffer is the reintroductions of the GST. But I think with the current scenario is unlikely. You have to see probably after next year. I don't think it's next year as well. So going forward, we think that the market will continue to be volatile. You can see that the market, the volatility is actually has spiked up at the beginning of the year. For this year's itself, this is the 10-year chart. We do believe that the Malaysian market will be a V-shaped recovery. So the 1220 that happens in 19th of March will be the bottom. But again, I think how well is the recovery will very much depends on the corporate earnings going forward. And beside that, also the bank, whether you see more bad debts after September when the borrowers start to pay back their loan repayments. And of course, is the politics in a country, and then how soon the vaccine is found to treat the COVID-19, as well as the US and China trade tensions. That is how it's going to affect the overall market. For the past 3 months, the Malaysia's market actually is fueled by the retailer, as I mentioned just now, with a high beta. So that is the reason why the small caps actually is outperform the KLCI. The small cap actually jumped almost 60%, while the KLCI is only up, only recover 25%. And we think that with this, in the second half, probably the investment style will be more into a selective big cap instead of the small cap. Compared to regionally, Malaysia's market performed relatively better. We only down like less than 10%. I think it's about 9% compared to Singapore, Thailand, Indonesia, and Philippines, which is down from 16 to 22% year to date. And our target for the end target CI is 1422. Basically, we are based on 12.2 times PE based on next year. That's actually is one standard deviation above its 10-year mean. And for earnings itself, last year we are doing something like 95.2 cents. Last month actually we have cut earnings for this year and next year by 9%, basically for the adjustment for the COVID-19 impact, as well as the oil price and from the banks itself. So many things is actually we expect the earning for next year to down by about 19% compared to 2019. And our forecasts are slightly higher than the consensus. Consensus is looking at 77.2 cents. We are looking at about 84.5 cents. And for next year, we are seeing a recovery, which we expect about 87.8 cents, which is this is about 3% lower than the consensus. So what is going to drive the earnings higher in next year? Basically, we expect a strong recovery in gaming earnings, because this year the 3-month closures due to the lockdown that impacted badly on Genting Malaysia, Genting, even Bitoto, Magnums. And next year we expect a strong recovery. And I think the other reason is because this year will be a low base impact. And we will still continue to see good earnings growth next year. That's basically because of thanks to glove stocks. They have been registering strong earnings. Even in the first quarter that they have shown, the top glove posted a 300%, more than 300% jump in their earnings compared to a year ago. The Supermax actually up by 100% as well. And next year we still expect a good jump as well, because their order, the orders actually today you place, you only get the order in a year's time, and the ASP actually is increasing by about 5% every month. So that is a big jump earnings for next year as well. And of course, we will expect a higher earnings from the building that basically from the the press matter, because of the low base effect from this year of their sharp declining in the ASP. So with the recovery in ASP, next year earning will be higher. That also coupled with the new capacity, about 41% that which is going to kick in by January next year. So basically, this is how drive the earnings for next year. So overall, for next quarter, we are overweight on constructions. This high beta stocks that is always a beneficiary for any pump priming. Gaming, basically because of the heavy sell-down, dividends, the valuations look very attractive. And also for the MFO side, the dividend yield is very attractive, it's above 6%. Property, property is overweight, but we don't really, not that we like the sector. That why is overweight is basically because of the valuations. Their variation is in a multiple year low, and you will see that more and more companies buy back a share. And in fact, there are two companies that they are proposed to privatize it. So can you imagine that the valuation is so low that the company, the owner want to privatize it. Then of course the Gulf have been the darling of the markets actually for the past 3 months. Supermax share price jumped 5 times within more than a month. Top Gulf up 200%, I think it's 250%. Hatalega up about 150%, and the so-called worst performer, Khosan, also up 100% in the past 3 months. So we believe that this sector will continue to grow. They will still continue to attract more interest because of the demand that thanks to the COVID-19 that have driven out have driven the demand for Gulf. Then the next sector that we have overweight is basically technology. Technology is, of course, is also the high beta, cyclical high beta. Technology is the way forward. So we will still see we are hopeful on this sector. And lastly is the utility. Utility basically earnings are very defensive. Stocks like Kenanga, stocks like Petronas Gas Malaysia, their earnings are regulated with the regulated returns. Beside that, the IPP like YTL Power and Marakov, they have offer a very good dividend yield, above 7% actually. Okay, so that's basically what we see for third quarter. But again, let me share with you why we think that the 1220 will be the bottom, and we expect we expect a V-shaped recovery in the Malaysia market, because this 1220 is actually is about 1.2 times books, which is equivalent to the last financial crisis low. And with the earning forecast, that's to present about 13.6 times PE for next 12 months. That's actually is 2 standard deviation below its mean. So I think it's unlikely that the CI is going to test that level. Technically, it's same as well. That's also is well supported, that you can see. Okay, that's end my presentations. Let me take some questions. Okay, let me answer the first questions. Malaysia Gulf and technology stocks still have lots of room to grow and upwards. I think yes. Like I mentioned just now, can you imagine that today you place an order? I mean, this is for Gulf. Today you place an order, you only get an order in 12 months' time. And your order, the price is on the spot spot price 12 months from now is not today's price. Sorry, it's a forward price, not today's price. That price will only decide during that time. And what we gather from all those glove makers is that the selling price for the gloves is actually increased by 5% every month. So you can see the multiple effect on that. The question also asked is that now, like let's say I take a top glove as an example. The share, if based on this year earnings, the PE is 40 times. But if you factor in for next year earning growth, actually the PE is go down to 15 times only. Is actually not that expensive. Looking at our market, CI actually next year earning based on today's price is 16 times. The PE for top glove is only 15 times, but provided our forecast is correct lah. But based on what we see today, I think it's highly likely that they're going to achieve that type of number. You can see now the target price everyone put high and higher. I think our in-house target for top glove is 25 ringgit. We have seen the highest is 30 ringgit. And currently the share price is about 17 or 18 ringgit. So we still see more upside. Technology, yes. We have good technology, semiconductors related stocks in Penang. That is the hubs actually. Stocks that you can look at is like Inari, Great Tax, MI, Dufu. If based on their this year earnings, they are trading at about 30-40 times as well. But I think this year, because you have to take into the impacts for the lockdown for I think more than 3 months, not exactly 3 months for this year. There are some of them they close for like a month, and subsequently they are allowed to operate like 25%, 50%, and 75%, and now 100%. So I think next year you will see more earning from that. So definitely yes. Why Kenanga Growth Fund performance is lacking? Okay, I think Kenanga Growth Funds, this basically is managed by our sister company, Kenanga Investor Berhad. What I can see from their stock selection, they are more into high beta stocks actually. So in fact, at one point it was negative. That during the meltdown, which is 19th of March, it was negative, but now it have moved up. So if the market keep recover, then we believe that the fund performance should be better. How the political uncertainty may affect the market? This one, I think it's a bit difficult to answer. Sorry if you mind, I'm not going to answer this one. Okay, I think this castle is a very interesting questions because of the anti-alcohol. Well, I think it's all about politics. Whether they're going to ban it or not, I doubt so. The governments, I mean, you have to come to reality. When you are opposition, you can give all sort of the opposition, you can reject whatever the government is doing. Because, okay, now the PN coalitions basically is almost 100% Malay party. Of course, they are against all this un-Islamic sector. But I think they will still remain. Just like sin stocks, like casino itself. The tax revenue contributions to the country is big. So some things that they cannot ignore. For Harta Lega target price, I need to check. If you mind, probably I will answer later. I think my colleague just raised his target Monday. If I'm not mistaken, is 18 ringgit. His target for 12 months, if I'm not mistaken, I think it's 18 ringgit from 13. Harta Lega, probably just can give some preview. Is one of our topic for third quarter, which is going to release next Wednesday. So probably you will see that among the four four big growth stocks, the one that actually have the better valuations or most expensive actually is Hata, because I think due to their profit margins. Okay. Dog glove, yes, just now I have an answer. Our target price is 25. I think due to the demand, yes. Okay, this Shin On questions about secure is the government. No, I think it's a bit difficult to answer that. There's more on politics. Okay, beside Inari, what are the chips or semiconductor player listed in KLCI? Okay. I mentioned stocks that you can look at is like Great Tech, Vitrox, Dofu, MI. These are the now the hot stock in Bursa Malaysia. Hot stock is not because of the speculations or what, basically because of the demand. They are the up and coming. Those days you will see Unisem, you will see MPI. I think they are those yesterday stocks. So they are the stock. Valuations why I think they are not cheap. You will based on today's this year earnings. They are trading over 30-40 times. But of course, with the better earnings next year, the PE will come down. Okay, variations. Okay, this growth again. I think among the four growth stock, the cheapest, if in terms of PE, is Top Growth. Even though that the share price now is the most expensive, basically because of the earning growth for next year are more stronger. Okay, this is a very interesting question. Malaysian market is supported by the retailer investor. Okay. Investor will eat any dry. I mean the money will dry out. For this, I think the money will still how to say the participation will still there. There are a few reasons actually. First of all, there's no short selling. The ban is extended to end of the year. So I think what you can expect is from now until end of the year, the market will still hot. Second, with such a low interest rate now, you put in a bank, you only get 2%. But I think Singapore probably this is probably the Singapore standard. But I think in the past Malaysia, you put FD easily, you can get 4%. But today, you're lucky if you can get 2%. So 2%. You place it for 12 months, you only get 2%, but you put in a stock market with those good potential stock. I think that probably the reason why they went in markets when the market was crashed down. So the momentum will be still there for now. So with the no short selling until end of the year, I think the market will be still quite robust. Whether can buy and invest our invest in Kenanga investment share. In my company. To me, I always feel that IB is a tough business. The interest, how to say, the com is keep lower. So it's a tough business. But I think this year everyone should report a good earnings for this year because of the strong trade volume for the past 3 months. Technology stocks, I think that's how I've answered. Okay, HRS. This is a bit tough. I think for me, I feel it's cross country. It's two countries, so we're not putting the list because I think there's a lot of uncertainty. Okay, you want my contact? Probably you can just drop me an email. My email is T-E-H, my surname, K-Y, which is my the initial name from my middle name. TKY at Kenanga, KENANGA.com.my. Okay, provisions for the growth in industry performance after the COVID-19. Yes, I think this is a one concern for most of the professional fund manager, because that when the COVID-19 found when the vaccine is out that can treat the COVID-19, will the demand for glove drop tremendously? The answer is difficult. I mean, I think this is a difficult question to answer. Basically, probably it will be a new norm. Just like today, I think everyone's wearing a mask to go everywhere. So whether this will, I believe that the demand will drop, but it will go to a certain extent. But another question we're going to ask is that, okay, can you imagine that top glove, Hatta Lega, they now, in terms of the market cap, they are top. Top Hatta Lega actually is top 4. Top glove is top 6. They are bigger than a bank actually. So a lot of people have questions whether does a manufacturer variations should be higher than a bank, which is governed by a stricter regulations. But as manufacturer, it's just a manufacturer. So I think it's a bit difficult to answer this. Give some bank stock. Can you give some stock that you can recommend other than glove? I think I'll buy technology. You want to play safe? You should buy Kenanga. I cover Kenanga for the past 10 years. I think this is a stock that hugely ignored by most of the fund manager, because that they always think that Kenanga National is a GLC that they need to do. National service. But if you're looking at it, actually now they have a regulated returns. The earnings is quite certain. The fuel cost is passed through. The demand is kept by the revenue caps. So meaning to say is that their earnings are very certain. And at today, the stock is only valued at 13 times PE compared to market about 16 times. And they offer 4% yield. So it's quite attractive. Okay, I think I should end now because my time is done. Okay, thank you.